Hello, everybody. This is a supplementary video for the remainder of Chapter 3 that we didn't get to cover in class on Tuesday, the 23rd. We just ran out of time, and I just got a little bit more to cover here, and I wanted to go over it. And just to make sure you had some additional content, this last bit is probably the most straightforward part of Chapter 3, which deals primarily with the balance sheet, and then we move into Chapter 4 dealing with the income statement. But we want to talk about ratios, financial ratios, and both how we categorize them and in terms of how we use them. And the first category we want to talk about are liquidity ratios. For those of you who took 2120 here at CNN, we actually pulled forward what was Chapter 10 in that text into managerial accounting, which doesn't really fit there because this is really more financial accounting than it is managerial accounting, but it was an effort to sort of balance out the chapter count, balance out the workload a little bit between 2110 and 2120. 2110 is obviously intro to financial, 2120 intro to managerial, but we cover that in that particular course. And so, if you still have your notes from that, a lot of that's going to be quite useful, I think. And there's not a lot that's too challenging, I don't believe, with regard to these ratios. And we talk about financial ratios. What are we really trying to do here? We're trying to essentially establish relationships. It's one thing to look at numbers on a financial statement and say, okay, this is what's happening. These are earnings. These are this is the net the shareholders' equity in the company and all that. But what does it really all mean? And it particularly is important to be able to compare across different firms, either in the same industry or across industries, as to certain amounts of things like profitability and whatnot. And we have certain categories. The first category is what we call liquidity ratios. And let's talk a bit about liquidity and what it is. I think that oftentimes there's a misunderstanding about what liquidity is versus solvency, and it's an easy one to confuse. That is the misapprehension here. Liquidity really deals more with the balance sheet concept of where things are, how liquid the firm is. Again, liquidity simply refers to the ability to convert assets to cash and to be able to pay obligations, particularly in the short run. And it really is a balance sheet concept. Solvency, on the other hand, is more of an income statement concept, where is the company generating earnings over the long haul? Is the company generating cash flow in order to meet its obligations longer term? And the two are similar, but they are different. So when we talk about liquidity ratios, we are sort of coming back to the main topics on the balance sheet, including current assets over current liabilities, which we simply call the current ratio. Now, one of the things about the current ratio, so it's going to be a number. It's not a dollar figure. It's not a percentage. It's just a number. And one of the things I should talk about with regard to current ratio is that I think at one point this was a more important ratio in the minds of users of financial statements and financial analysts and bankers and whatnot. And for a very long time, there was sort of a common rule of thumb that said that a company should have twice the current assets as it has current liabilities. That is really not at all so much prominent today, mostly because I think that there are some companies that don't want to tie up too many assets in the form of current assets, like cash or receivables, and would rather plow them into longer term assets. Plus, the idea of liquidity really suggests that is the company, or really asks the question, is the company able to pay its short-term obligations? And there's so many different sources for companies to raise cash today that it's really not all that difficult. Companies can issue commercial paper in a very quick manner in order to raise cash for whatever reason, to make payroll, to pay payables or taxes or whatever. And so it's not as prominent as it used to be. In fact, not only is 2-to-1 sort of an outdated concept, but even 1-to-1 is not even there. I think I pulled up Apple's statements not too long ago, and I think their current ratio was below 1. I can tell you that, meaning they don't currently have enough current assets to pay the current liabilities. That is current meaning within the operating cycle or a year, whichever is longer. And if you were not familiar with the importance of current ratio, or the maybe over exaggerated importance of current ratio, you'd say, Well, what's the problem with Apple? Well, there's not really a problem with Apple. I am sure that Apple is more than capable of meeting its short-term obligations, but the reasons why companies are running a little bit thinner in this regard, and I think it's simply because of the fact that some companies are just cash-generating machines, and so they can make those priorities and meet their priorities in all kinds of different ways. There's another ratio that we used a lot when I was in the financial analysis world, and it's something called the quick ratio, sometimes called the acid test ratio. And that is, I think, a really old school term. I'm not even sure where that term comes from, acid test, but it's simply current assets over current liabilities, where we adjust for inventory. We simply take inventory out of the picture and say, can this company make its current obligations if they sold no inventory whatsoever? And the thing about inventory is that it's sometimes slow moving. Well, it depends upon the industry. There's obviously the inventory turnover, the rate of inventory movement is sometimes faster within some industries as opposed to others. But the idea of removing inventories, and by the way, you can adjust it for inventory or other kind of assets that you don't want to include in the numerator here. It's just simply a way of saying, okay, if we remove those and didn't rely upon selling of inventory, what would the ratio be? It's really a variation. It's sort of a twist on current ratio is really all it is. And then another twist is simply, okay, if current ratio is a number, and the quick ratio is a number, it's just simply one number divided by another number. In other words, a dollar figure divided by a dollar figure. Well, the working capital figure is a dollar figure. And so this is something to keep in mind. That it's very much related to the current ratio, except that it's simply current assets minus current liabilities, and you're going to get a dollar figure. And it's simply the excess of current assets over current liabilities. If there is excess or if there's a deficiency, then it's going to be a negative figure, but it's going to be expressed in terms of dollars. And so when we talk about working capital of a company, we're saying this is what the company has in excess of current assets over current liabilities in a dollar standpoint. And we can kind of work, and it's what we have to work with in order to make these current obligations. And so the example given here was that working capital for Nike was $10,587,000,000. That was computed as current assets of $16 billion minus current liabilities of $5 billion. And that is a very large amount of working capital. And by the way, if you took the current ratio, it'd be 16 divided by 5 is 3 something. And that's a very high amount for Nike or really for any company. I don't know what year that's for, but you get the idea that the ratios are very much related to one another. Current ratio and quick ratio are numbers. Working capital is a dollar figure. Okay. So in this case, we go back to, I guess it was 2017. I guess it does say when it is. And the number of, I said 3, it's close to 3. The current ratio, 16 billion over 5.4 billion, is 2.93, meaning that for every dollar of current liabilities, the company has $2.93 on hand right now in order to pay those current liabilities. And that's a pretty good cash position. And whether or not that's too high of a ratio, and I've heard this argument before that maybe you don't want so much in the way of current assets, and maybe you want to reward shareholders by paying that out in the form of dividends or whatever, right? That's another subject altogether, but it's nonetheless an argument that can be made, particularly if you feel like the current ratio is too high. I know that I worked with a company once where the CFO was constantly complaining about getting phone calls from shareholders. They wanted higher dividends. And he said, it's just part of my job to take these calls from prominent shareholders, but we didn't want to pay higher dividends, which obviously is a cash drain out of the company. But you get the idea. The current ratio takes that into account because obviously paying dividends is going to reduce cash levels if it's a cash dividend, which is the most common form. Then when we talk about the quick ratio, again, inventory is the major excluded item. You could take, if you wanted to, prepaid items, things like prepaid insurance, prepaid rent, whatever, any kind of restricted cash, whereas cash is segregated for whatever purpose, such as to settle lawsuits in which the company is a defendant, or to pay fines, or whatever, maybe to settle indebtedness where the company wants to segregate funds and whatnot. Certainly in the financial world, certainly in banking, we create reserves to create things like loan losses and whatnot. And but anyway, taking those out, inventory is probably the major excluded item when it comes to quick ratio. If the company has inventory, now there are some companies that have no inventory, in which case the current ratio is the main liquidity ratio, at least in the very short term. And so as a result, quick assets are those which do not include things like inventory and whatnot, but it would include cash and receivables and all that. Okay, so in this case, the quick ratio from Nike is 1.8. That's still fairly good, pretty good. It means that they have enough on hand in order to cover. So it's a high coverage ratio when it comes to liquidity. And what is really interesting and meaningful about all these ratios, really, it's not just these liquidity ratios, but a lot of other ratios, or what do they really mean? And sometimes it's important to find out how a company stacks up in terms of industry averages. And so, and where do these industry averages come from? How would a company or anybody, any user, determine what is the industry average? And there are research organizations that prepare this information. Certainly for publicly traded companies, there are a lot of this data is easily available. But even for non-public companies, there are companies like RMA that produce in Dun & Bradstreet that are able to sort of compile this information so that users can get an idea as to whether or not these ratios are in line, whether they're too low, too high, and whatnot. And one of the things that I will say here, and it's something that I do, particularly when we talk about this in Principles 2, is the idea that we say, whatever the ratio is or the relationship, higher the better, the lower the better. In this case, we're going to say both current ratio and quick ratio, the higher the better, with the caveat that if it's too high, I mean, is the company really allocating its assets in the right way? Maybe they should do something else with cash, maybe invest in research or whatever. So in general, you got to take this kind of with a grain of salt. Yes, higher the better. Because what's the alternative? Being low is not good either, because you have got a problem in the sense that you've got to somehow raise cash in order to pay those current obligations. And so these have to be taken with a grain of salt. So in this case, the industry average, the current ratio is 1.4, acid test or quick ratio is 1.15. Nike's are higher than industry average. And so we would say, okay, that's higher. If higher is better, then Nike is better than the industry average. For whatever industry this is, footwear, athletic footwear, I guess you could say, or also apparel. Nike does a lot of things, and they can even make golf clubs and whatnot. So you could say that they're in better shape from a liquidity standpoint than their industry peers. Okay, and that's something to consider, right? And you just can't look at one particular company and say, okay, this is good or bad, without giving the bigger picture or the bigger context of what's going on. So quick quiz here: liquidity ratios. Which of the following transactions would increase a company's liquidity ratios? Okay, well, receive cash from customers on receivables, purchase office supplies with cash, pay dividends to shareholders, borrow cash by signing a 3-year note. This is a little bit of a tricky one, and the answer here is D, borrowing cash by signing a 3-year note. What happens is current assets go up and current liabilities both go up. That doesn't mean it's going to result in the same ratio. It just depends upon what the numbers are. When I first saw this, I thought, well, this looks pretty good too. A, receiving cash from customers on accounts receivable. However, in reality, what's going on here is you're lowering one current asset, accounts receivable, replacing it with cash. And so that kind of looks a little bit deceiving in that regard. But the correct answer is going to be D, borrowing cash by signing a 3-year note. And by the way, sometimes companies will do short-term borrowings just in order to sort of pump up their financial ratios. Certainly, if you're a company that's a non-public company where a lot of the outside financing is bank debt, bankers a lot of times want certain ratios to be met, and companies will go to sometimes great lengths in order to make sure that those ratios are met, because it's actually part of the loan covenant itself. And as a former banker, I can tell you that we watch this stuff, and if they're not in compliance, well, we've got a conversation to have, right? So, and it's not always a case in which the sky is falling, but it is something that is required to be in compliance, and so companies will sometimes go to pretty extreme lengths to make that happen. All right, so those liquidity ratios. Let's talk about solvency ratios. Again, I mentioned at the outset that they're different. They seem like they're the same, but they're really not. And what we're really talking about here is this idea of over a fairly long time period, is the company better able to meet its long-term obligations? It's got a lot to do with the income statement, where the liquidity ratio is not so much. However, in the case of one of the most important ones, debt to equity, it's simply one value divided by another. It's total liabilities over shareholders' equity. In this case, we'll say the lower the better. The lower the better. Why? Because it means that a company has more financial flexibility if it has less debt. Just like ordinary individuals have more flexibility if they have less debt. And the same goes here with companies themselves. Sometimes too much debt sort of hems you in, and you've got to devote a lot of your resources just in order to make what we call debt service, that is, meeting the obligations of the lender. Okay. The second one definitely brings the income statement into account. That's what we call times interest earned ratio. It's simply net income plus interest expense plus income taxes divided back into interest expense. Now, why do we add these guys back here? We do it because net income has already taken net interest expense and taxes out. We're assuming net income is net income after tax. And so if we're talking about the resources available to pay interest obligations, then you have to add those back in because they've already been taken out. So you add back interest expense and income tax, and then divided by interest expense. And here we say the lower the better, here we say the higher the better. The greater the coverage ratio, the debt service coverage ratio, the better off the borrower is, the better off the lender is if they have that particular amount of coverage existing. So that's essentially, those are some big issues when it comes to solvency. Can the company manage their obligations over the long term? The debt equity ratio, I think, is probably maybe more important even than the coverage ratio of debt service coverage, that is the times interest earned, because really it sort of compares how much of the business is funded by equity, or how much is funded by debt and how much is funded by equity, right? Either however you want to look at it. So remember, the right side of the balance sheet is what we call the equities side of the balance sheet. And that is that the assets are funded somehow, and of those assets, the share of ownership, or the share of interest, maybe not ownership is probably the wrong word, but the share of interest in those assets is in the form of owner's equity, and that would be equity, or just simply equity, and that is of creditor's equity, which is simply debt. So we say the lower the better in general, because it means the company is less leveraged or levered, right? And leverage in the balance sheet context refers to how much debt the company has. Now, leverage and borrowing in general is not necessarily a bad thing. And I know that a lot of people would look at debt and say, well, you shouldn't have any debt whatsoever, or being in debt is a bad thing. And I think we have to kind of divorce ourselves from linking these metaphors between household economics and that of businesses. But even households, a little bit of debt may be a good thing. I mean, most people wouldn't be able to buy a house if they didn't have some borrowings in order to do it. Certainly, a lot of our students wouldn't be here if we didn't have borrowing. So I think we want to sort of disabuse ourselves of the negative view of debt in general. It's relative, and so we say the lower the better, simply because of the fact that it gives more flexibility to the company or the borrowing entity, in this case, if there is a lower amount of debt in relation to equity. It's a matter of balance. And it really depends upon, what the preferences are of those who are lending, that is the creditors, whether the bankers or bondholders, as to how much debt is acceptable to them. In general, the higher the ratio, the higher the risk. And that's really what's going on here. In other words, increase what we call financial leverage. And financial leverage is simply this idea of using somebody else's money, and which is what debt really is, and having to repay it, but leverage can be out of control when it's excessive. And there are some companies with a tremendous amount of debt out there, and it makes them, a riskier bet. And if things go wrong, they don't have quite as much room to move. In other words, what we call financial flexibility. And so a lower debt to equity ratio is considered to be generally more positive than a higher one. Okay. And we'll talk a bit more about leverage here in a second, and how leverage itself is not a negative thing. In fact, it's considered a positive thing. In fact, we make the case for those of you who will go on and take finance courses, usually a 300 level, introductory to finance course, that there's a concept in finance and economics known as the Modigliani-Miller theorem that really suggests that companies should have some debt, and they should be really indifferent as to debt versus equity. what they really want to accomplish is the best benefit. And sometimes borrowing money makes a heck of a lot of sense. Using someone else's money to make more money on that, that's kind of the American way. And liabilities in and of themselves are not bad. Okay, so here's an example. This is taking the Nike example once again. Debt to equity ratio is 0.87, and that is considered to be a fairly low leverage ratio, debt to equity ratio. The industry average is 0.95, so it's pretty close, but it's lower. And Nike in this case has lower default risk. This is always a debate among lenders and bondholders as to how high this ratio can go before there is concern about the amount of debt in relation to equity. And I know that when I was in the financial world, we wanted this number to be a little bit below 2. We might edge it up a little bit, but if you're thinking about what that means, it means for every dollar of equity or ownership, there's $2 that are of creditors' interest in that. So this is not written in stone. I wouldn't write it down, but I'm just simply saying that we began to be a little bit worried when debt to equity ratios climbed a little bit too high for the reasons that I had just mentioned a second ago. So it reduces flexibility. And also there's something to be said for the fact that if any kind of an ownership has less of an interest in the business than creditors do, then how motivated are they to do all the things they have to do to service the debt, to generate a return and all that when their equity interest is not that high. Okay. And then back to the times earned interest ratio, which we say the higher the better, to remain solvent or take on more debt. A company that needed to have funds available to pay those. And so if it's many times greater, then that's a good thing. And a lot of companies have lots and lots of coverage, what we call debt service coverage. And so when that's the case, that's considered to be a positive thing. And so in this regard, back to Nike, they have income before interest and taxes of $4,945,000 over interest, which is 59 million. In this case, the times earned interest ratio then is a pretty gigantic 83. And this may not be really representative of too many companies. That is a big, big, big number. But nonetheless, it's higher the better. And I can't think of any downside to having a higher coverage ratio in that regard. Okay. And let me get to the idea of risk and profitability and what this all means. And it sort of implies that debt is a feature of this. And when we talk about this idea of leverage, I think we have to have a very modern and mature understanding of what's going on here. Debt in and of itself is not bad. The ability to service debt is obviously a requirement for borrowing, but there's a reason why we call this leverage, and that is the idea, just like in science physics, where you use a lever to move a big rock, like a big, whatever it is, that you're moving something bigger with something smaller, and that's what leverage really is. That's what really I think where the term comes from, and it gives a bit of flexibility. So borrowing is a good thing. Remember, one of the things that is a sort of now is a cornerstone of finance is the idea that a company that doesn't have any debt is probably making a mistake. And I don't think that's an exaggerated statement whatsoever. I think that since the 1950s, when this idea of the Modigliani-Miller model came about, which you don't have to write down or anything, but it's become pretty much a cornerstone activity. Both won Nobel Prizes, by the way, at different times for their work. But it's the idea that you can use other people's money to make more money, and it's risky as you add more debt, but nonetheless, risk and return tend to go hand in hand. So sometimes more debt can mean a higher return on shareholders' equity, and that's an important principle of finance. We certainly saw this in the 1980s, where companies were taking lots and lots of debt to do lots and lots of things, particularly buying other companies, and in many cases, it paid off. So here's the example. There are two examples in this particular segment about leverage, and they're both the facts are the same, except for the size of the income statement, size of the company, in other words. And so here we have a newly formed corporation is attempting to determine the appropriate mix of debt and equity. That's a very common question. So initial capitalization goal is 50 million, composed of, in this case, 10 million in debt, 40 million in equity. All right, so pretty good mix there, very low leverage. 30 million in debt and 20 million in equity. And we're going to say income before interest and taxes is going to be 8 million, because those are operating results independent of what the capital structure looks like. Capital structure meaning the composition, the mix of debt and equity in all its various forms. And we're not going to get too deeply into different kinds of debt and different kinds of equity. Let's just take the big categories themselves, and we'll kind of do that. We will drill into equity, types of equity and types of debt a bit later. But right now, let's just sort of focus on that. So in this regard, we have, in the first case, we have 800,000 in interest expense and 4.3 million in net income, divided by the 40 million return on equity, right? And we get a 10.8% return on equity. Return on equity, which is, by the way, what we call a profitability ratio, is simply a measure of how every dollar of equity yields a return. In this case, it's usually on an after-tax basis. In this case, for every dollar of equity or ownership stake in the company, 10 cents is generated. Pretty good return on equity, maybe not the highest, but pretty good. The alternative two is a little bit more levered, where now we have not 10 million, but 30 million in debt. So the balance has changed. We have about a 1.5 debt to equity ratio, right? It was about a 0.2 debt to equity ratio. But here's what happens, right? We have a lot higher interest expense, right? We have net income before taxes. We have 3,360,000. A lot of it is because we're paying more in interest. But look at this, the equity is smaller, so it reduces the denominator. And yes, you have reduced the numerator as well, but you have a much higher return on equity. And so this is an example of how leverage can be beneficial if you're looking to earn substantial returns on equity. And there's been a lot of research and thinking about what sort of minimum return on equity is acceptable. And I don't know that there's any sort of consensus on this. I've heard different numbers over the years, but it really depends upon the industry. And some industries don't generate that high of returns, but these are industries that are mostly insulated from competition, and therefore they are operating and they're making money. And why not just keep letting it roll, right? But so it really sort of varies. But I would say 16% is a very respectable return on equity. On the other hand, what if we have a smaller base to start with? And so we take the two capital structure alternatives. We have the same interest expense from the previous example, but it's on a lower income figure here. And so in alternative one, we have a 3.3% return on equity. That is a pretty paltry return, but guess what? It's even worse when it comes to adding more debt, because the advantage here is you're spreading out more of this interest over a higher base of sales, a higher base with the previous example. Here it's lower, and so now it's an even worse condition. We have 1.8% return on shareholders' equity, and I would consider that to be not a particularly high ROE, and nothing to write home about whatsoever. And so as a result, leverage can work in both ways. It tends to favor the bigger firms as opposed to the smaller firms. But guess what? Almost everywhere, having done this for a while, I can tell you it's probably better to be bigger than smaller, just because of the mathematical effects of these sorts of things. And this is not what everyone wants to hear, but in this case, this is an example of how a smaller firm really can't absorb the debt. And it doesn't really make sense to add more debt, more leverage. Okay, quick quiz here. Geisner Inc. has total assets of $1 million, total liabilities of $600,000. The industry average debt to equity is 1.2. Calculate their debt to equity ratio and indicate whether the company's default risk is higher or lower. Well, all right. Well, if total assets are $1 million and total liabilities of $600,000, that must mean total equity has to be $400,000. So debt of $600,000 divided by equity of $400,000 is going to be 1.5, and indicate and that's higher than the industry average. So it's going to be 1.5. It's going to be C, 1.5, a higher default risk. It's not super high. It's not, I wouldn't be, necessarily thinking this company's heading to bankruptcy, but it's a little bit higher than in the industry average. But maybe it's okay. Maybe this is a fast-growing company that needs this leverage to kind of get going. And keep in mind, a lot of great businesses have been funded with debt. Standard Oil, which became the dominant oil company in the U.S., was almost entirely, at least in the early stages, funded with borrowing, where John D. Rockefeller went around the banks and said, just lend me all you can. And certainly he also raised equity capital, but it was very substantially funded with debt, and it made a lot of sense to do. So there's the answer to that one there. Also, there's not a lot really to say about reportable segment information. we can, in fact, separate business entities out by operating segments. And within company financial statements, you see 10Ks, 10Qs, Ks being the annual statements, Qs being quarterly. That we can break out, and sometimes companies will sort of break these out and say, okay, this is this particular entity, this is the I don't know, the transmission division of whatever, right? Or this is the muffler division, whatever the case might be, right? And so that's an operating segment that stands alone, almost as a separate little business in its own right. Sometimes has its own, own management that doesn't really have much to do with other entities, and we certainly have seen this in many, many big companies where these entities don't really talk to each other. I can certainly tell you that when I was in the business world, there were a lot of divisions that we not only did we not have anything to do with them, but we sort of thought that they were not really on our side at all. They were sometimes competing against us, and some companies like that particular cultural facet that others do not. But from an accounting standpoint, let's not worry about that. Let's talk about the idea that we have different operating segments that are sometimes information is disclosed separately. Sometimes in the past, companies sometimes didn't want to include that. They thought it was maybe too strategic to give away to the rest of the world what was going on internally, but I think you're seeing more of that disclosure now. So what amounts are reported by an operating segment? Well, general information about the segment, information about the reported segment profit or loss, reconciliations of the totals of segment revenues, reported profit, loss, assets, yada, yada, interim period information. Well, it is essentially all of those things. All of those things are, it's really not a quiz, it's sort of just kind of a listing of all those things are reported by operating segment. And these income statements are, or balance sheet income statement information is oftentimes broken out separately so that users can determine what's going on with individual segments if they prefer. Okay. All right. And back to Abbott Labs. This is just an example of how we would break out different segments. And I assume this is accurate information. I know Abbott is obviously a well-established company, but you've got these different elements, different operating environments, different, sometimes we call them SBUs or strategic business units, pharmaceuticals, nutritionals, diagnostics, and whatnot. And a lot of big public companies have these different, almost like different companies, and sometimes they really are operating under the corporate umbrella. And they have sometimes way different customers, different inputs, different ways of doing business, and they sometimes compete against other units of the business. Hopefully that's not in a destructive manner, but nonetheless, you get the idea that sometimes these little operating segments are standalone entities in their own right. Also, GAAP requires that reporting companies break out revenues from customers domestically and also attribute it to foreign countries. And when it comes to foreign countries in particular, there's been some recent guidance from FASB about how to report currency issues because you can do business in multiple countries in the world and have different currencies involved. Not every country in Europe is on the euro. Some countries that are not, like Norway has its own currency, Switzerland has its own currency, Britain does, and whatnot. And so one of the more recent guidance that came down, what we call an ASU, required companies to break these out individually by country so that people could understand, users could understand how the changes in currency valuation affected the bottom line. Usually going to comprehensive income, which is something we're going to revisit in chapter 4, this idea of what comprehensive income is. It's really it's tangential to the daily operations of the company, but nonetheless have an impact on income and equity. Also, long-lived assets are broken out and divided by domestic versus foreign countries as well. So these are sort of required disclosures that are there. Also, information about major customers. The idea that if a company is losing more than 10% of revenue from one particular customer, then that has to be disclosed, along with how much is expected to be lost and who and where that sort of belongs, what operating entity within the company that belongs to. And so users can determine what is up with that particular thing. And one final thing here, the very last, is in the international standards, we say that US GAAP requires companies to report based upon individual segment areas. Also, the IFRS standards requires the companies also disclose the amount of liabilities that belong to those in addition to U.S. GAAP item requirements. The standards are a bit different, and they really are. And there are a lot of differences between GAAP and IFRS standards, and those are things that we talk about intermittently here in intermediate accounting. For those of you who may go on to take advanced accounting courses, particularly in the lead up to CPA exam or maybe a master's in accounting, you probably will drill down even deeper into these sort of differences here and talk about how they matter. And as I mentioned at the very beginning of the semester, that there's been an effort to sort of engage in what we call convergence between the international standards and GAAP. And it's not always been a smooth effort, and it looks like we probably are not going to make a huge amount of progress. But to the extent that progress is being made, it makes a lot of sense. And by the way, this really puts the onus on accountants to understand both GAAP standards as well as international standards, because a lot of companies do business in other countries as well where different standards apply. So it's important that there's this sort of flexibility and knowledge that's going on. And so I can tell you certainly from having taught in graduate school in accounting that that's a big issue, and it has been for, this is not new, it's been a big issue for a long time, this idea of getting people prepared to understand international standards as well. Okay? All right, well, I think that does it for chapter 3. I just wanted to put a little supplementary video into this just because we ran out of time on Tuesday. And so when we come back next week, week 5, we are going to be covering chapter 4, the rest of chapter 4 exclusively, and we'll talk more about the issue of the income statement, comprehensive income, the cash flow statement. We'll get to all those topics as well. So in the meantime, as I say always, feel free to reach out to me if you have questions. I'm here to help, and I will see you all next time.